Wall Street would love another big gift from the Fed in time for Christmas. Why not? Will they get it, though? Find out next from Chapwood Capital President Ed Butowsky. It is a month traditionally dominated by the bulls. I say traditionally, but deprived of their lifeline from the Fed, at least for the time being. Stock investors are selling in December. For example, the Nasdaq has closed lower than it opened 10 times for the month, while closing higher than the open only 3 times. Have stock investors become fatally addicted to government help? And what does that mean for your portfolio? Well, who better to ask than Chapwood Capital Investment Managing Director Ed Butowsky, and who manages, by the way, over $1 billion, that's with a B, dollars. Ed, you know, this has been a tough market, obviously, but December, no Santa rally in sight, is there?
No, there isn't. And thanks for having me on, because I think it's an important discussion. We have become, as investors, hypersensitive to everything coming out of Washington. And really what we do is we hold our breath. And when something good comes out, we don't really see stock prices go up. Everyone's waiting for negative news, and then you see sell programs kick in. So this December, is very unlike a lot of other Decembers. I'm more concerned about January and February of next year, because I don't see a lot of good news coming out in terms of the economic picture. So I'm concerned for the next January, February, March coming up. And
a lot of these headlines today was another example where we find out that the EU finance ministers can't agree on another bailout. And of course, it's almost hourly now that we seem to get these less than stellar reports coming out of Europe, and it affects the markets every time. And do you really see that changing in the near term?
No, I'll tell you, there is a huge problem that isn't being talked about, and that is about 94% of all the volume on the exchanges are done by computers, but more importantly, by institutional investors. Yeah. It's not you and I. I'd like to think that I have enough money to move this market, but I don't, and most of the people, most individuals don't. So what people have to do is take a longer-term perspective. Don't worry day to day, week by week, and you have to look and say, am I going to be an investor for the next 5 years? And if so, buy good quality equities that pay dividends and go to work and make the economy grow.
So investors out there looking for advisors, how can they tell if an advisor is any good? What are the telltale signs?
Yeah, it's tough because we all come in different shapes and colors, don't we? I mean, you look at me and I look like the typical investment advisor, okay? But you never know who's a good one. But here's a couple of rules of thumb.
Yeah.
First thing, you want to make sure that someone's talking about purchasing power and keeping your purchasing power. If they don't talk about what do they expect to make after taxes, investment fees, management fees, and not the CPI, but your cost of living, that's what you need to be having a discussion with, not what the government number is, which is the CPI. You want to make sure that you have a targeted growth rate over and above taxes, investment management fees, and your cost of living. That's the first thing you want to know. If the advisor's any good, he's talking or she's talking about that.
And I guess, look at the long term. I'm sure, as you say, check their long-term record as opposed to the last, 3 months. I'm sure that's very important as well.
Yeah, it's tough to get somebody's record. A lot of them don't have records, and a lot of them isn't transferable. Make sure if they tell you about buying into a bond fund or buying bonds right now, you politely exit, leave, close the door, and never go back to that person. Right now, you do not buy bonds, Ashley.
And there's a real tendency to panic when we see these big market swings and the volatility index starts to rise, and people will cash in. What do they do with that? Do they just buy those, U.S. Treasury bonds? I mean, where does the safe money go these days?
Right. Well, look, the question is, safe from, it going down, you just put it in money market, because if you put it in bonds and interest rates rise, which they will, you're going to lose value there. So if you want to have no exposure to the market, you go into money market. However, you're guaranteeing yourself one thing. You go to money market right now, you're guaranteeing yourself a loss of about 5% purchasing power a year.
Crazy.
So what you need to do is learn how to construct a portfolio that can weather many different storms and take a long-term perspective. That's how you're going to offset really this volatility.
And then being the optimist, there's got to be some good value in the market as well, right?
I think there are. I mean, right now, the overall stock market's about 20% undervalued. To me, the number one place to be putting money right now that's going to satisfy a lot of your needs, which is income and stability and a little bit of growth, go into that utility sector. I've been saying it for a long time. We're up about 18% in the last 12, 18 months on utilities, and I think you're going to continue to see a 10, 15% growth year over year in the utility industry. So that's where I would focus right now with any money you have sitting on the sidelines.
Very good. Everyone needs utilities. Ed Butowsky, Chapwood Capital Investment. Ed, thank you so much for joining us. Great information.
Thanks for
Thank
having
you.
me.